Welcome to the Deep Dive, where we crack open complex topics using your insights and sources to distill what truly matters. We're aiming to cut through the noise, get to the core of what you need to know without all the information overload. Today, we're kicking off a brand new series we're calling Navigating a Business Model. Hmm. The whole idea here is to dissect the fundamental parts of any business into these actionable, understandable chunks, and we're calling them atomic units. Each deep dive will really zero in on one crucial aspect, giving you clear explanations and hopefully some practical insights, whether we're, say, a budding entrepreneur, maybe a startup founder, or even a seasoned leader. And for this specific deep dive, episode 17 in our series, we're tackling something absolutely foundational. It's crucial for any venture's success: sizing your market opportunity. Just think about all the brilliant ideas that just sort of
Uh,
vanish, right? Often it wasn't the idea itself that was flawed. It was more about understanding who would actually buy it and critically whether there were enough of them.
that's exactly right. Because look, whether you're building a new product or launching a service, you absolutely need to confidently validate its market size. You just can't afford to be the proverbial big fish in a small pond, no matter how brilliant or innovative your idea might seem. A fantastic product in a tiny, maybe unreachable market.
Yeah.
It's basically, well, it's a fantastic hobby, not really a scalable business.
Yeah, and it's not just about, personal ambition either. As we'll get into, investors, particularly those looking for significant returns, they have a really strong bias towards ideas with genuinely large, scalable market potential. They're seeking ventures that have the, quote, potential to change the world or at least reach significant scale. Think maybe north of $50 million in annual revenues within, say, 5 years. If you want to attract that serious capital and really grow, you've got to show them the size of the prize.
Exactly. So today we'll explore why understanding your market isn't just a good idea, it's pretty much essential for survival. And crucially, how you actually approach estimating it effectively.
Okay, so let's dive into this then. Why is market sizing so critically important? I mean, it seems kind of self-evident to many, maybe, but what are the deeper reasons beyond just, well, it needs to be big?
Well, our sources really highlight a fundamental truth here.
Hmm.
Entrepreneurs and investors, they fundamentally look for large or, importantly, rapidly growing markets. It's simply a question of, well, economics and effort, really. It's significantly easier to gain market share when the market itself is expanding. When new customers are constantly entering the space, it's much easier than having to aggressively fight really entrenched competitors over a pie that's shrinking or just stagnant.
Right. Fighting for scraps versus riding a wave.
Precisely. And smart investors, especially venture capitalists, they actively seek out these high growth potential markets early on. That's where the truly exponential payoffs are found.
Hmm.
They're not just looking for a good business, they're looking for a business that can be enormously good. And a massive market, it allows for mistakes, it allows for pivots, and for scaling well beyond what you might have initially expected. It just provides that headroom for truly transformative growth.
It almost sounds like that old field of dreams fallacy, doesn't it? If you build it, they will come. Bosses. But our sources warn pretty strongly that in the real world, this strategy is not very sensible. You might pour your heart and soul, everything, into creating an undeniably great product, only to discover it's just prohibitively expensive to find the customers who can and will actually buy it. And that's exactly why validating market size is so critical right from the get-go.
Absolutely. The economic viability of just accessing your customers is paramount. If your market's too small or maybe too fragmented, even a highly successful venture within it might not generate enough revenue to satisfy those growth-focused investors, or maybe even just sustain itself long-term and offer a compelling return to its founders. You could be the undisputed leader in a market of like 10 people,
Oh,
and that's just not going to pay the bills or attract any significant investment.
okay, that makes sense. So, how do we start putting some actual numbers to this idea of market size? We often hear terms like TAM and SAM just sort of bandied about in business plans and pitches. Can you clarify what those actually mean in practical terms, especially maybe for someone just starting out?
Of course. Let's think of it in layers, maybe. First, you've got the total addressable market, or TAM. This is like the entire revenue opportunity available for a product or service if you somehow achieved 100% market share. Crazy, I know.
Hmm.
It's the total universe of potential customers who could theoretically use your product.
Yeah.
Doesn't matter about current competition or even your ability to reach them right now. It's the absolute maximum possible ceiling.
The theoretical
Yeah.
maximum.
Okay. For instance, our sources talk about this company, Dinner, a meal kit delivery service. They looked at the UK grocery market. Their TAM was basically the entire UK grocery market, which at the time was worth a staggering 157 billion,
Wow.
right? Because theoretically, everyone buys groceries, and meal kits are just an alternative to traditional grocery shopping. That's a massive TAM.
Okay, huge number, but not very practical on its own, maybe.
Exactly. So within that vast ocean of the TAM, you then have the served available market, or SAM. Now, this is the segment of that TAM that you can realistically serve with your current business model, your specific offerings, your resources. It's where your particular strategy fits, where you plan to compete today. It's a much more grounded, practical number.
Right, the part you can actually reach.
So for Dinar, right, while the overall UK grocery market was at 157 billion pounds, they knew they couldn't possibly serve all of it. So by analyzing the growth rate and penetration of a similar successful Swedish company, Middagsfred, they estimated their addressable business in the UK to be around 1 billion. This 1 billion pounds, that represented their SAM, a realistic, though still ambitious target within that much larger grocery market.
Got it. So TAM is the big, ambitious dream, the potential ceiling if everything went perfectly, and SAM is your actual battleground where you're focusing your energy right now.
That's precisely it. It's about being grounded in reality while, still aiming high. And once you have these concepts sort of defined, there are two main ways people usually try to estimate these market sizes, top down and bottom up.
Okay, let's unpack those two methods then, maybe sticking with our dinero example. How would you approach dinero using a top-down method to get to that 1 billion pound SAM figure?
Right. So the top-down approach, it starts with that big total market number, the TAM, and then you slice it down, you segment it to estimate your served market. For Dinar, like we said, they started with the overall UK grocery market at 157 billion. Then they layered in their specific product, meal kits. By looking at that successful comparison, Middagsfrid in Sweden and its growth rate in its home market, they basically projected a percentage of that huge grocery market that meal kits could realistically capture in the UK. And that's how they landed on their 1 billion pound SAM. There's a top-down way. It gives you a quick kind of broad estimate of the potential. It's good for showing the overall scale, the potential ceiling to investors. It demonstrates the why bother factor.
Okay, so it paints the big picture. But what about the bottom-up approach? How would that look for a company like Dinar or really any startup? It sounds like a totally different way of thinking.
It really is quite different, yeah. Instead of starting big and slicing down, bottom-up builds your estimate from the ground up. You focus on individual customers or potential transactions. Our sources highlight that entrepreneurs who follow a lean startup approach often monitor their customer conversion funnel really closely. This means tracking prospects through different stages. How many people see your marketing? How many actually become new customers? And then crucially, how many become repeat buyers?
Ah, the funnel, right.
Exactly. And you combine this funnel data with key metrics like customer lifetime value, LTV, 4, variable contribution margin earned from a typical customer, net of the average customer acquisition cost, SEK. Then you can build a very granular picture.
Okay, hold on a sec there. For listeners, can you just quickly break down LTV and the SEK again? Those acronyms fly around a lot.
Sure, absolutely. Good point. So LTV, customer lifetime value, is basically the total profit a business expects to make from a single customer over the entire time they do business with you. And CAC, customer acquisition cost, is simply what it costs on average to get one new paying customer. What you're really trying to figure out is, can you acquire customers profitably? Is the LTV significantly higher than the CAC? Because like we said, a huge market means absolutely nothing if it costs you more to get a customer than they'll ever actually spend with you. Right. You'd just be burning cash faster in a bigger market. Exactly. So for Dinar, a bottom-up approach would have involved estimating, say, how many actual households in the UK would realistically pay for a meal kit service. Then figuring out what it would cost to acquire each one through specific channels, maybe Facebook ads, maybe partnerships, and then estimating the profit each household would generate over time. Then you just scale that up based on how many customers you think you can realistically acquire.
Okay, so it seems like these two approaches, top down and bottom up, they almost tell different parts of the story, don't they? How do we reconcile them? And when is one more, reliable or useful than the other?
That's a great question. They provide clarity precisely because they cross-validate each other. The top-down gives you that sense of potential scale. It answers, is there enough room here to build something substantial? Is this market even worth pursuing?
Yeah.
It confirms the overall opportunity, builds confidence, especially for investors.
The big why.
The big why, exactly. The bottom up, though, that forces you to validate the actual demand and profitability at the micro level, at the per customer level. It answers, Can we actually make money doing this? Is our business model fundamentally sound? For new venture, honestly, the bottom-up approach, focusing on tangible customer behavior and those unit economics, that can reveal critical flaws that a really high-level top-down estimate might completely gloss over. For instance, if your bottom-up math shows that acquiring customers is just way too expensive or their LTV is disappointingly low, well, then that impressive top-down 1 billion market size means absolutely nothing in terms of your actual ability to succeed in it.
Ah, okay. So the real insight here isn't choosing one method over the other, but actually using both in tandem. Top down gives you the why bother, confirms the big potential. Bottom up gives you the how to actually succeed by validating the nitty-gritty economics. You need both to tell a convincing, realistic story.
Exactly.
Yeah.
Couldn't have put it better. And this leads us straight to a really critical point. What are the inherent issues with these market estimates, and why do they need to keep changing? It really sounds like it's certainly not a set it and forget it kind of number you calculate once.
You're absolutely right about that. Our sources actually warn that the market is as fickle as it is unpredictable, and also that it is not always easy to answer questions about the likely consumer response to new products or services, and so forward. The Denur case itself provides a pretty stark, almost painful example of this exact problem.
Indeed, it does. Despite their seemingly robust top-down market sizing, they learned the hard way. The absolute key to understanding Denur's failure, according to our sources, was that they fundamentally were not solving anyone's problem. They admitted they made the big mistake of presenting people with the idea and asking them if they liked it and would buy it. Classic mistake. And when people said yes, we thought they meant launch it and I will buy. But that's often not what yes means in that context. It just highlights how initial market research can be incredibly misleading if it doesn't uncover genuine, pressing problems and a true, demonstrated willingness to pay. People often say yes to be polite, or maybe they like the idea in theory, but not enough to actually open their wallet when the time comes. Precisely. And furthermore, our sources detail how consumers often fail to buy products that companies expect them to adopt. It's fascinating. And this isn't always about the product's objective value. Is it better or not? Sometimes it's more about the minds of people and their deep-seated behavioral biases. Think about something like loss aversion, right? This is the idea where people tend to value what they already possess much more than what they could potentially gain by switching to something new. It feels risky. This bias alone can significantly slow down adoption, making your initial market growth projections incredibly difficult to hit if you don't account for it.
That makes perfect sense. We're often just more comfortable with the status quo, the devil we know, even if it's imperfect. So any innovation, it needs to offer a truly substantial gain, like a 10x improvement maybe, just to overcome that natural inertia, that resistance to change.
Precisely. Yeah, think about the example sometimes used of TiVo versus the DVD player back in the late 90s. While TiVo offered really significant new value doing things a VCR just couldn't, like pausing live TV, it required a significant change in how users behaved, a whole new way of thinking about watching TV. And this led to much, much slower adoption than the DVD player. Why? Because the DVD player fit pretty much seamlessly into everyday behavior. It simply replaced your VCR with a higher quality, more convenient version of what you already did. No big behavioral shift needed. So this shows how behavioral inertia, like loss aversion, can dramatically slow market adoption. It can make your initial market growth projections look wildly optimistic if you haven't factored it in. Companies that wrongly assume that the adoption of new products will be rapid risk burning through their resources way too quickly.
Yeah.
They run out of cash before the market finally catches up.
Wow.
So, okay, what does this all mean for market estimates then? Clearly, they can't just be static numbers you calculate once and put in a drawer. They absolutely need to evolve. Absolutely. They have to be living documents. Because market conditions shift constantly. Customer needs evolve. New competitors pop up seemingly overnight. What might have looked like a viable, attractive market segment yesterday could be saturated or even obsolete today. So companies need to be continuously analyzing their business environment and, maybe most critically, their actual customer behavior. What are people really doing? The example of Zipcar in our sources is great here. It shows how their founders meticulously captured and analyzed monthly metrics. They did this to learn more quickly and constantly refine their business model assumptions. They weren't just guessing based on their initial plan. They were reacting to real-world data month by month.
So it's a continuous feedback loop.
Exactly. This constant learning, this adaptation based on real-world data, it's absolutely essential. It keeps your market estimates relevant. It helps you avoid that big fish in a small pond scenario, even after you launched and think you figured it out. It's really about building that feedback loop right into your strategy. You're constantly validating and adjusting your understanding of who your customers really are, what problems you're actually solving for them, and how much they're truly willing to pay for that solution.
This deep dive really does underline that market sizing isn't just, a number you plug into a business plan slide. It's a dynamic, ongoing process. It's about understanding your true potential, rigorously validating actual demand, and then being ready and willing to adapt to a constantly shifting landscape.
And what's really fascinating here, I think, is that while that grand vision, that massive TAM, captures attention and maybe opens investor doors, true, sustainable success ultimately hinges on understanding those granular realities. The nitty-gritty of customer acquisition cost and customer lifetime value, right down at the ground level.
So, what does this all mean for you listening? Well, if you're embarking on a new venture, please don't just rely on broad, top down industry reports to tell you if your idea is viable. You've got to dig deep with that bottom up validation. Talk to potential customers, real ones. Run small experiments. Rigorously track your unit economics from day one. And if you're already in business, remember that your market is a living, breathing entity. It's not static. Continuously reassess. Learn from your data. What's it really telling you? And be prepared to pivot your understanding of where your true opportunities actually lie. They might shift.
Yeah, and maybe this raises an important question for you to think about. When you're assessing your next big idea or even your current business, are you truly seeing the entire ocean, that big TAM potential? Or you maybe just focused on the small part of the pond you're already swimming in? And perhaps more importantly, are you actually measuring if the fish are biting? Are you seeing real traction? Or are you just kind of hoping they eventually will?